Good afternoon, everyone, and thanks so much for joining the third session of our digitization series. In the first session, we covered the need for digitization in financial institutions, where we talked about the opportunities, challenges, and risks around digitization itself. In the second session, we focused a little bit around the topic on the need for digital KYC itself, the innovations around and the solutions that organizations are looking at. And in the third session today, we'll be looking at the need for automated credit decisioning. We have two distinguished guests who are at the forefront of the topic that we are looking at. We have Harsh from Magma and Parijat from formerly from CRIF. He is an industry expert, a freelance consultant as of now. So thanks so much, Harsh and Parijat, for joining us and agreeing to share your thoughts with us today.
Thank you, Arun. Thank you for having us.
Great. So before we move ahead with the session itself, I thought we'll give a quick intro to both Harsh and Parijat. We'll start with Harsh. Harshvardhan Chamria is the Chief Digital Officer for Magma FinCorp. He's leading the digital transformation projects for Magma. Harsh drives tech transformation across various business verticals like asset-backed finance, housing finance, SME, and Magma's HDI General Insurance. Harsh is also spearheading multiple innovation projects like technology-enabled scoring models, document parsers, and tech APIs for automated underwriting at Magma. Harsh is also a director on the board of Experian India and is part of the strategic advisory group at Experian. He also serves as an angel investor and advisor to a bunch of fintech startups in India. Harsh graduated from Cornell and he's also an MBA from Stanford. Harsh, with the work that you're doing, I'm sure you'll have a lot of insights to share. So thanks so much for joining. And I'm sure our participants are going to take a lot from you today.
Thanks for having me, Arun, and look forward to hearing your and Parijat's views as well.
Thanks so much. And about Parijat, Parijat Garg is an expert in the field of credit information and credit decisioning with nearly 2 decades of rich experience in BFSI. Until recently, he was the Senior Vice President at CRIF India, with involvement across product sales, marketing, communications, operations, and regulatory compliance. He's currently working as an independent consultant on data management, credit risk management, business strategy with early stage fintechs and NBFCs both. CRIF has also worked with Infosys in multiple product and project management roles before joining CRIF. Parijat holds an MBA from IIM Kolkata. Parijat, thanks so much for joining, and I'm sure with multiple years of work at CRIF and your current role, you'll also have a lot to share on the specific topic of automated credit decisioning with our participants.
My pleasure, Arun. Thank you to you and Dvara to have me here, and look forward to a fantastic discussion today.
Awesome. So we'll not waste any more time. We will. What we will do is I will quickly give an intro to the topic and the need for the topic, and after that, for about 30 to 35 minutes, we will have a conversation with Harsh and Parijat. And we will take your questions for the last 10 to 15 minutes of the session. Meanwhile, if you have any questions whatsoever, you can post them in the Q&A tab that you can see on your screen, right? So let me project my screen. So why do we need automated credit decisioning, right? So all of us know that the central question of credit decisioning, as we know traditionally, is whom to lend and how much to lend. Traditionally, we've seen people looking at KYC documents. Then what is the ability to repay? This is ascertained through looking at the debt servicing capacity of the customer itself, looking at the income, expenses, liabilities, and so on. So then you can arrive at whether this customer can repay or not. Then whether the customer has the intent to repay. This is quite critical in credit business. So this is the place where traditionally a lot of proxies have been used, and even in the new digital world, we are seeing a lot of companies using these proxies like information from the credit bureau itself, where you look at historical credit behavior of the customer. Then you look at what is the regularity of bill payments by customers in addition to credit payments, things like electricity bill, mobile bill, rentals, and so on. Then in the last couple of years, we've seen GST emerging as a very critical component of understanding credit behavior of customers in terms of how they are making their tax payments, for two reasons. One, whether they are paying their tax on time, and second, more importantly, how healthy is their business. So that is another proxy for looking at the repayment capability. And finally, there are newer tools which are getting used, like psychometric tests and so on. So these are the multiple modes people use to understand whether one can lend to a particular person, number one. Number two, what is the extent to which financial institutions can take risk on lending to that person, right? So while we have these two things, people have followed many traditional models in the past. Recently, we've seen the emergence of fintechs, where companies use their own proprietary credit rules engine. And as you can see, this is a black box kind of a thing, because this is where their years of work goes into, and one can understand why the need for protection of this. And this is where things like scores, past data understanding of the customers goes into. And finally, fintechs and other people who are using digital modes of credit decisioning use these credit rules engine and arrive at a credit decision in terms of whom to lend and how much to lend, both. And like we've seen in the past two sessions, there are innumerable benefits, and three very direct things that we looked at past sessions, and it holds good for credit decisioning as well. One, digital modes give the benefit of reduced OPEX for the financial institution itself, because from, let's say, 10 stages, now you're looking at a couple of stages driven by technology. We will show you what we mean by from 10 stages to 2 stages in the subsequent slide. And the other two benefits, which are directly to the customer in terms of reduction in TAT. In our last session, one of the guests said they were able to reduce the turnaround times of loan processing from 18 days to probably 3 days. That's phenomenal, right? So faster loan processing for the customer. And because the OPEX is less and the time spent is less in terms of processing the loans, we believe the financial institutions would pass the benefit to the customer, so they would have a reduced loan pricing for the customer as well. So there are benefits, and we've seen financial institutions, the ways in which they are doing it, and there is real benefit in terms of going about automating your credit decisioning. And so this is a depiction of the traditional lending process, right? So you can see KYC, you have a checker, and then you have application, you have another checker, you have personal discussions, then you have multiple rounds of credit before credit decisioning. This is a traditional process which multiple organizations follow for their credit decisioning itself. You can see the what is technology doing straight away from KYC. Today, if you have your processes and technology in place, you can automate these multiple stages and directly approve loans, right? You can have a set of scores, you can have a set of rules, and you can have a set of proxies like what we saw in the previous slide. And then say, now I don't have to go through these 10 stages. It's just 2 stages. I get your KYC, I have this understanding the black box, and based on that, I will sanction the loan. So we've seen people automating it, and I'm sure we will hear more from both Harsh and Parijat in terms of their experience in doing this. So without wasting any more time, I will pause here and would request maybe start with Harsh and sort of share his initial experience of the transformation that Harsh and team are doing at Magma. Magma, we all know, is a large company with interests in multiple asset classes. So they are, Harsh is leading the effort in terms of transforming them from a more of a manual operations to a completely digital operations. So Harsh, would love to hear from you initially on your thoughts on overall digitization and how we are doing credit decisioning at Magma.
Sure, thanks, Arun. And I think it's a really great two short slides that you've shown around credit automation and credit decisioning automation. I think it's very succinct, and I think the product that you guys have is also really reflective of this clarity that you all have of thought. So first of all, I think I'd just like to say that I think COVID really has been quite a catchment event, for the entire industry. And we were discussing before that, we believe that what demonetization was to the digital payments industry, COVID might become to actually the digital lending industry. Therefore, there's a lot of how we will be talking about BC and AC, or AD, which is before COVID and after COVID. Right. I think this time is really going to see a lot of blurring of the lines between traditional NBFCs or banks and fintechs. So I think there's two tectonic shifts that we are really seeing. One, over the last 2 years, I think the fintech industry is really, the fintech lending industry has really been leading the way around building digital customer journeys. I think post-COVID, what has happened is most organizations are looking for ways to go paperless, looking for ways to go contactless, and looking for ways to go presenceless. Now, the fintech lending industry is something which is always focused more on the unsecured loans, smaller loans, and there, they have not gone entirely paperless, but gone paper light. On the traditional side, the loans have been slightly more secured, although there have been a lot of growth in the unsecured loans in the traditional NBFCs and banks now. But generally, there have been more secured loans and larger loans. So I think what we are seeing both at Magma and in the industry now is actually a journey of moving from high touch to low touch, a lot of paper to less paper, emails to digital workflows, and localized processing to digital centralized processing. And the digital transformation journeys that organizations like Magma and the entire industry, I think traditional lenders are going through, is to actually traverse, from these four endpoints of paper, email, local, and high touch into the digital sort of arena. The traditional lending process, there's really 4 steps. There's KYC, there is data collection, there is underwriting, and then there's finally disbursement. And then, of course, you have your servicing bit of it. So I think what we're doing at Magma is to actually see each of these 4 elements and see how we can digitize and how we can go paperless. We have 3 lending businesses. We lend to we lend for auto finance, where we lend for cars, trucks, construction equipment, and tractor. We have mortgage, where we are in affordable housing. So we lend, to small self-employed non-professionals or informal salaried individuals. And there the average loan size is about 10 to 12 lakhs. And third business we have on the lending side is the SME loans, where we lend to formal enterprises. These are of the turnover of between 1 crore to 25 crore generally. And there we give, that's the only unsecured loan product that we have, where we give about 20 lakh rupees, on average. What we're doing across, across these 3 lines of businesses and across these 4 elements of the loan process is that we have actually digitized a large bit of it. So on the KYC front, the video KYC norms have just, about come out a few months ago. To be honest, we've not really focused as much on it because there are other elements where we believe we can have a much greater impact in digitalization of our loan journeys. So where we've actually gone a long distances, we've actually digitized a fair bit of our data collection and our underwriting. And also now the disbursement. So on the data collection front, we are validating the KYC digitally. We are pulling bank statements, through either tie-ups with fintechs like Perfios and Onfido, or we are, getting the PDF bank statements from the customers over email or over their customer application. We are pulling ITRs in a similar way. We're pulling financial statements in a similar way. We're pulling GST returns in a similar way. On the underwriting side, what we're doing is we have actually put in place a multi-bureau, so that if a single bureau is not able to recognize a customer, doesn't have a record on a single bureau, we automatically move to the next and the next and the next. NBFCs traditionally have always built scorecards which are not dependent entirely on the bureau history. So in fact, one interesting data point I can share, 75% of our through the door customers on the auto finance business, so that's 3 out of 4 customers in the auto finance business are actually new to credit. Despite that, 2/3 of our lending decisions in the auto finance business are completely automated. There is no human intervention whatsoever now, despite lending to people who don't have any credit history. We start with the multi-bureau, and then we build scorecards, which we have then digitized by putting into a credit rule engine of sorts. The scorecard that has been built has actually been built by doing a lot of data analytics on the customer data that we've gathered over the last 2 decades. Obviously, the quality of data that we had earlier was not as good as the quality of data that we had in the last 5 years or the last 10 years. So you kind of have a scrubbing of the data, and I can get more into that later. But essentially, we built scorecards for the auto finance business, scorecards for the SME business, and we're in the process of doing the same for the housing business also. So data collection and underwriting, fair bit of digitization. On the disbursal front, actually, there's been some very exciting changes that have happened. I think COVID, has also really changed the ability, or rather the readiness of customers and our own internal employees to accept and adopt digital. So, earlier e-sign for loan agreements was around for a long time, but neither customers nor our employees were really comfortable in trying it out. Now, actually, there's a desire. Customers say, if you don't want to use paper, we're more than happy. So we are actually sending the loan agreements, with some tech tie-ups that we've done with the signing agencies or signing fintechs, and we are doing digital signature with the Aadhaar-based OTP. We have, as you would have heard, there's a recent regulation that came out which allowed again the Aadhaar-based OTP for the e-NACH. And we have just about started that as well now. In fact, it's starting from the middle of July for the entire industry. So I'll just pause there for a bit. But as I said, KYC, lesser digitization, we don't see as much success there. But data collection, underwriting, disbursal, fair bit of automation.
Fabulous, Harsh. Thanks for those initial thoughts. We really hope what you said is true on what is demand for digital payments. Could possibly convert COVID into that for digital credit, right? We'll get into aspects of KYC, data collection, underwriting, the low touch that you shared a little bit later. But let's move on to Parijat now. Parijat, given that you've worked with multiple financial institutions in the past, and your current role is around consulting financial institutions on their digital and credit journey, would like to hear your initial thoughts on what are financial institutions doing and what is your reaction?
So, thanks, Arun, and hi to everyone in the audience. So I think I'll just pick up from what Harsh mentioned. So essentially, if I have to just summarize or pick a few points from what Harsh mentioned, the key to any digitalized journey or digital transformation are built on 3 strong pillars: technology, data, and analytics, right? So data was getting generated. Every NBFC, every financing organization was collecting information over the years. It's use of technology that's making the data available in digital format. And because there's better technology available, you are able to analyze that better. So essentially it becomes like a virtuous cycle, which better analytics ensures that you are actually implementing or investing in better technology to really work upon. So in some ways, I see that being fulcrum of every player which is right now looking at lending, whether they were traditional players or whether they're new age fintechs. The new age fintechs, of course, are starting with a very high degree of technology maturity and technology adoption, whereas the traditional players were very mature on their business processes and their underwriting and processes, their understanding of the market, their understanding of the cyclicity of the lending process. But so as Harsh said, we are seeing a convergence happening. So if I actually pick up like a 2x2 for business maturity and technology maturity in some ways, then maybe some of the traditional players were high on business maturity, and now they are moving towards the technology maturity and getting to that right top corner quadrant, which is what I think everyone would like to do. And I think the drivers are not just efficiency per se, but it is also growingly the customer demanding. And I think Harsh touched upon it towards his end of the statement, where the customers today want better experience. Customers are not just working with a traditional NBFC, they are also working with fintechs. They know that there are solutions available for paperless, say, agreements. So they become demanding, and this is also propelling many players to speed up or to hasten up their digitalization journey or digital transformation journey. So I think that's something which is really positive for the industry. That will not only bring in efficiencies in terms of cost, in terms of the productivity, but also allow every player to be more scalable. So I think earlier our businesses were very geographically focused, were focused on specific branch-led models. But now if everything is available on internet or on mobile apps, it's very easy for you to service onboard customers from anywhere in the country without having to worry about creating a risky profile. So I think that's something that I'm really excited about, and something which maybe COVID is becoming a catalyst, as Harsh said, but that's, I think, propelling everyone to focus on different elements of lending journey, not only in the customer onboarding pieces, but also on the servicing and collection pieces as well. Of course, the adoption on the onboarding piece is significantly higher as compared to on the servicing and the collection elements. Those are slightly slow on the adoption track, but I do expect in next 2 to 3 years, we should see a lot of innovation coming in, a lot of acceptance coming in towards implementing such solutions and customers accepting those solutions to be in practice.
That's actually a very interesting point, Parijat, that you make, which is why do you think the adoption is higher in the onboarding part and that much lesser in the other two in terms of servicing and collections?
So I think the solutions, so I believe the real trigger point before COVID happened was the India stack, I think architecture that got created in India, and Harsh also briefly touched upon the presence-less, the paperless, cashless sort of journey. So I think all of that conceptualization which happened on the fundamentals of JAM, the Jan Dhan accounts, the mobile-based delivery system, and Aadhaar as a unique identifier, I think all of that really triggered a journey on the onboarding pieces. And customer today is much more excited to get credit. And growingly in India, we have a higher millennial demography, which is very digital savvy, which wants hassle-free, convenience-based products, which are not really requiring too much friction in their transaction. So if you look at any consumer tech companies as well, who are offering, say, postpaid, for example, Paytm or Ola for that matter, which were not traditionally into any kind of credit product, are now offering postpaid services, which are essentially a very ultra short-term lending products in some form. And they're making it extremely frictionless for a consumer. When I'm taking a ride at Ola, it's just a click of a button and I get a 15-day credit on my Ola postpaid account. Similarly, it is available on Swiggy for that matter. So I think these are examples of really making customers so comfortable with lending that it is not becoming a product, but it is actually translating into a feature in a scheme of things.
I think that's a very interesting point that Parijat has brought up, Arun, on the onboarding versus the servicing. And I think the one place where the industry has really done a lot of work around building frictionless journeys is to actually service customers who are what is in the traditional NBFCs called GTR or ETR, which is good track record or excellent track record. And I think several of the NBFCs and banks have built, pretty successful pre-approved programs for their existing customer sets, wherein the subsequent loan, second loan, third loan, fourth loan, so on and so forth, is relatively frictionless. There, in fact, even the risk and policy teams of the lenders are much more comfortable going digital, because there is one primary agreement which is still in paper, which can be accepted by the local courts in even smaller cities in the country. And there's a digital agreement to top up, the second loan which has been given. So, in fact, I can share another interesting data point. We, as I said, 3/4 of our customers through the door are new to credit in auto finance. 1/3 of our business now, almost 1/3 of our business now is actually repeat customer loans. What we have done is we've built a sort of data mart, a cross-sell data mart as part of a larger data warehouse building that we're doing, wherein we are constantly churning data for our on-us, portfolio behavior of the customers. Which is the standard bucketing, average delay, peak delay, bounces, so on and so forth. Overlaying that with the credit bureau scrub of the customer to see how the same customer is performing off us, off the lender, off Magma. And, basis that, creating offers, for these customers. So I think on the servicing side, the cross-sell loan or the repeat sell loan has really picked up. In fact, and as I said, the frictionless journeys have been designed, out there. And I think much like in the startup world, there is a concept of customer acquisition cost and lifetime value. I think similarly, this concept is really, permeating the lending space quite seriously, such that the second loan, the third loan, and so on and so forth is much more profitable for the lender, and also ends up resulting in a much cleaner loan book. And therefore, the secondary and onwards loans are also much cheaper for the customer, having demonstrated the credit quality. And this applies more to new to credit or thin file customers. Because they have proven to the lender that they are actually creditworthy, and therefore, deserve credit at a much lower cost. I think that's somewhere where there has been a fair bit of work that has been done. I would also like to add that on the collection side now, there's a fair bit of innovation we see with the UPI applications which have come up. And also, with the digital payments industry really exploding. So we are having a lot of link-based collections going out, wherein earlier, the promise to pay, the PTP, was generated by the telecaller, and the FOs would be sent on the ground to pick up cash from the customer. Now the customer is also quite comfortable actually getting a link on their phone and paying through UPI, knowing that they don't have to pay personal visit charges anymore. And I think that's another place where the digital payments industry really has helped reduce costs and increase convenience for both the customer and the lender.
Sure, that's fantastic. I do want to spend some time with both of you on the process that financial institutions can undertake in their transformation journey towards adopting automated credit decisioning. That's one. Second is in terms of how can they go about building data itself and then using them for credit decisioning. But before that, I want to spend a couple of minutes, Harsh, on the point that you mentioned around high touch, moving from high touch physically to high touch digitally, right? While the touch is going to be very low in terms of presence-less, paperless kind of a thing. But from a digital perspective, we are talking about from anything from high to very high touch digitally, right? So how do you see that very high physical touch moving towards very high digital touch work for the customer?
I think that's very interesting, Arun, the question that you're asking. And I can tell you that, with most of the fintechs who we speak with, who we work with, and many of the large traditional DSAs who have now created, digital shops for acquisition as well, what we see in India is that it's not digital that works, but phygital that works. And the reason I say that is that despite having designed reasonably frictionless customer journeys, which can be done entirely on an application, on a mobile application, we find that what is most prevalent and what the customer is most comfortable with is actually getting a phone call from a telecaller who will actually assist him or her, through the entire process, and just tell them that, why don't you go to this website? Why don't you download your bank statement? Make sure it's 12 months or 6 months or 3 months, whatever the requirement is. For your ITR, you're going to get this OTP, please plug that in, and so on and so forth. So they really like that, sort of phone call assistance journey. And often with some of more of our traditional customers in semi-urban rural areas, we actually find that the first time they're doing this journey, they almost don't mind having an FOs do it in front of them, physically. So it's actually the phygital, leg, which I think is very, very critical. And even you even have digital fintechs in the country who have large FOS teams now, because they've also realized that for their growth they really need this physical leg. After the first interaction, I think the second interaction onwards, the customer is quite comfortable going digital. But that first interaction, that push is required, and that that comfort is required on actually going digital. That's on one bit, which is on the customer's own readiness and comfort with digital. On the second bit, I think there is always, a slight fear in the customer's mind of providing ID password. So for example, on the net banking side, we don't find customers very comfortable providing net banking details, despite having all the ISO X1000, stamps and so on and so forth, and working with companies who do this for a living. They're more than happy sharing PDF statements, but they don't want to, get into the net banking ID password, and that's the most tricky one. Same applies for tax statements and GST and so on and so forth. So I think that's also going to be a little bit of a journey that will be traversed. And again, the midway that India has adopted, I think, is the PDF, uploading, parsing the PDF, and having those data points be populated in the loan origination systems and the credit rule engines. Of course, what that does, though, it adds the leg of the RCU, which is the risk control, risk containment unit required, where you need to have a physical, you have a person physically going and checking whether the statement is indeed, authentic, or whether it has been tampered with. And of course, you have some AIML that's been built out there to, to take care of some of that physical check. But I think it's that journey that we are traversing, right? So the APIs are available. And I always joke with my fintech sort of friends that, look, you guys are building commodity, right? So you're building APIs and everyone can use APIs. So then why should you really exist? But I think it's that execution challenge of putting an API, making sure you have the physical field force and the telecalling, force to actually aid the customer, and then make sure everything works in a frictionless journey. And I think that's the difference between, the cup and the lip. And I think that's what really separates a good fintech from, from a fintech that's not growing as fast, because that execution challenge still exists in India because of the mindsets that people have and the journey it will take them to actually traverse, the time it will take them to traverse that journey.
It's very interesting, right? You have to actually show them it works, and it works at least once, and for them to actually see it. And then once they see the magic happening, I think they will start understanding the sort of benefits of this over what they were getting traditionally, right? So that's
absolutely
that's fantastic. Parijat, wanted to hear your thoughts on what are the things. You're an industry expert who is consulting financial institutions now. What are the ways in which financial institutions can go about this journey of converting their traditional credit decisioning practices, credit underwriting practices to more automated? What are the steps you would suggest them to take?
So I think, Arun, that's a very important question for any company which is looking to digitally transform their underwriting process. And underwriting is sort of the heart or the brain for the entire lending business. And like say traditionally, players have used rule-based assessment models, or there were scorecard-based assessment models where you would create some sort of analytical structure around giving some weightages to certain variables. You will calculate those variables, or there could be those would be maybe basic variables coming from application information or any kind of documents that you were collecting. Now, all of that was primarily being done, as Harsh said, locally perhaps, or if there was a primary LOS system that they were using, it might be going into a central system, but still it was primarily a rule-based decision where you have if then else communication, right? If this is a situation, then this will be the decision. If the credit score is above 700, then it's an approve. If the income is more than 3 lakhs, then I am considering this customer. If the customer stays in this particular city, I am willing to service this customer. If the person is employed at this employer, then I'm willing to service this customer. So there were certain rule-based assessments. So if I look at the underwriting journey or underwriting processes and split it into further modules, then there was an eligibility check that was happening, followed by maybe some sort of a risk assessment module that was there. Then you would have some sort of an output pricing decision points that you were actually deciding. Now, for anyone to believe in this, why should they look at a digital transformation of this process, is maybe 3 or 4 key points. One, you are standardizing your entire process by putting into a machine rather than leaving it to subjective elements. This does not necessarily mean that you have to do away with people who understand credit, but this is to assist the people who understand credit, but help them focus on exceptions, focus on key parameters rather than focusing on the basics of underwriting. So I think that's point number 1. Point number 2 is that it becomes much more scalable. So if you have more volumes, you are not necessarily adding people in your credit team just to process those applications, but you are doing it smartly by giving more quality time to your staff as well. And all of this translates to a better customer turnaround. Like I think you said, some NBFC has experienced cutting down their turnaround time from 18 days to 3 days. That can happen only when you have belief in such processes, right? And those processes also bring in more consistency in your decision making. It brings in more transparency in your decision making. If you have to audit what went wrong, if you were just dependent on how people were thinking about that application, how they interpreted that data versus what a machine is doing, then you have much more credibility in terms of how you audit, how do you govern your processes, how do you refine your processes in future. So I think all of these benefits are something that one needs to understand why an automated credit decisioning is required. And I'm right now focusing primarily on the onboarding or maybe the acquisition piece of it. But similar things would apply to what Harsh mentioned on the servicing pieces of it. If you are looking at giving someone a pre-approved loan, because you already know the track record, even if it's a new to credit customer, how do you really put that all together? And as Harsh said, if they have, say, lakhs of customers, which are existing customers, how do you really filter out and say, okay, these are the 90 customers out of 100 that I want to offer or make a pre-approved offer? And within them, the kind of decisions also, I think in your slide, you mentioned what to lend and how to lend. So what product to offer, what should be my limit to offer. So suppose I'm offering a personal loan to a vehicle loan customer of Magma, what should be my offer? Should I make an offer of 1 lakh rupees or should it be for 50,000? What should be my tenure? So use of all of these pieces are actually taking away from a broader segmental approach to a segment of one, where I'm actually able to drill down and say, okay, this is Arun. This is Arun's profile. Parijat's profile and Arun's profile looks almost similar, but I'm still able to differentiate in my product offering between Arun and Parijat by using all of these techniques, all of this automation, and without actually increasing my cost, without actually putting an undue burden on my staff. I think that's the approach that one needs to look at. And of course, we can go deeper into it, but I'll take a pause here and maybe let her share his views on it, or maybe if you have any further questions.
No, so one very interesting thing that you pointed out is when people think about doing digital transformation, right? It's not about replacing people. It is about augmenting their strengths with the technology strengths that you have, so that you can make conditioning that much better rather than replacing people. It's very important that you highlight that, because in our experience also, we've seen people within organizations getting anxious the moment they think of their roles being replaced with technology. So it's very important to emphasize that it's not replacement of people, but it is bringing in more strengths to actually augment that overall credit decisioning itself. So that's well said. Harsh, one of the things I wanted to touch upon with you is on the, see, you said 2/3 of your decisioning today is automated, at least on the unsecured side. I wanted to understand, do you guys have additional loan loss provision for these customers, or do you price them separately? How do you deal with that aspect?
So actually what I'll do is I'll combine, the answer to this question with something that, you mentioned right before this, which is that while 2/3 of our lending decisions are completely automated, there's no human intervention whatsoever in those decisions. What we do is we actually add a human overlay on not whether or not the loan will be given, but whether the amount of loan that is being given needs to be increased or decreased. And therefore, we ensure that, there is some bit of human oversight that is coming in. And the reason we do this is because we don't deal with very, very small loans. I think the same, same discussion if you were having with, let's say, a fintech lender or a PL lender, I think the conversation would be slightly different, because there the loans are small enough where you do actually need to take a complete sort of digitized, call. Also, just a little correction, the 2/3 decisions being automated are not only for our unsecured SME loans, which are the 20 lakh loans, but also for our auto finance loans, which are more on the 5 lakh, 6 lakh variety, and where we deal with car, sort of taxi drivers, truck drivers, farmers, and construction equipment contractors. So what we've done, Arun, is a little bit similar to what Parijat explained. I think the heart of all of this is actually data analytics. So, and I think it forms the heart, whether you want to call it the heart, the brain, whatever you want to call it.
Which is my, sorry to interrupt, which is my next question, and probably you can take it from there in terms of, so the thing about credit decisioning, right? So data plays a fundamental role there. It plays the central role there, right? So when an organization moves from manual physical process to automated process, they don't have this data with them, right? So you have these process converted into digital, create those data, and then use it for credit decisioning, or you start with it. It's a chicken and egg kind of a thing, right? Which one you start first? So maybe you can use your own example and also suggest how we can do that.
No, I think you're very, very spot on, Arun. I'll tell you, I'll give you share a couple of stories. So when we started this whole journey of, in fact, I remember I started, I joined in the SME business in Magma in 2014. And back then we used to run our entire business on Excels. So our entire CAM, was in Excel. And somewhere, we knew that these Excels are going to be, they say data is the new oil, right? So we knew that these Excels are going to be, valuable. So we started, we mandated in our LOS that you need to upload these Excels and store them. You cannot keep them in your computer. And then also, we had a lot of vintage resources. So the computers were still there. So we actually ended up, collating all these Excels over years and, downloading them from the document management system in the LOS. And we actually ran a very large data analytics exercise over, over 10 million data points. Sorry, actually, it was almost over 20 million data points that we analyzed, over 50,000 customers. We actually run logistic regression algorithms. We did variable selection, data cleansing, independent variable analysis, statistical significance, finding out binning of the variables, on lender, on bureau performance, bad definition, and all of the jazz to actually build this scorecard, right? So the reason I said it, I agree with you on the chicken and egg is, in this case, we had the data beforehand, because we were able to call it out from the computers and, get the Excel. In our mortgage business, on the other hand, we actually did not do that process of saving those Excels. And even if we did, those Excels, the data was not as clean. So we find there then that we have to rely on the experience of others. In that, we can go to the bureau and actually find customers of our type. How are they behaving, outside, and sort of get data from there. But obviously the experience is not as rich as having your own data, which you had used to underwrite the customer. So I would say that, a scorecard is, any model is garbage in, garbage out, right? So if you must have the data, you must be able to analyze it really well. You must make sure that there's no biases creeping in, and only then can you feel comfortable with, totally automated underwriting. If you don't have the data, then you can supplement it by going outside, getting it from the bureaus, working with fintechs like, there's Credit Vidya, and there's a bunch of others who also help NBFCs and banks make scorecards. But I think, this is the absolute heart and brain of the entire automation operation. And, one must spend undue time on this to make sure the model is fine. The other thing in lending, is that, and particularly automated underwriting, is that you don't know whether you've made a mistake on your underwriting till much later in the loan process. Much later after you've given the loan, right? So if it's a 30-month loan, let's say an SME unsecured loan is a 36-month loan, you're not going to know whether you've messed up in your model till 18 months are over, because your peak delinquency is around 60-70% of the tenure of the loan. If you're doing a 3-month loan, if you're doing a small sort of invoice financing or something like that, then you know very, very quickly. So I think the trick really is to make sure your model has played out. You have done enough back testing. and you've seen the peak delinquency hit. Without that, I think it's better to maybe digitize your processes, but not digitize the entire underwriting model. And I think right now the balance that companies are striking is to actually go to the bureau if they don't have their own data.
Save your Excels is the lesson, right?
Absolutely.
All right. So I think we have we had a very good discussion. Maybe we'll pause here and take some questions. Okay, so Parijat has been kind enough to answer that question, but still, for the benefit of everyone, I'll read out the question, and Parijat, you can share Vijay's, answer to Vijay's question.
Or maybe we can have Harsh share his views on that question. I've already shared it on the chat, so let him share his views. And he's more of a practitioner, I am more of a consultant. So let's hear Harsh's views.
Go ahead, please. Yeah, go ahead.
Yeah, so what Vijay is asking is, with credit decisioning becoming more digital and as consistency increases, would it lead to low audit intensity on that aspect? Will audit in credit institutions become obsolete?
No, I think I completely agree with Parijat's answer, which I think Parijat's written that there'll be more transparency and scale in the audit. If the credit decisioning is automated, the audit is not limited to sampling, but can cover all applications, and tech and analytics can assist auditors in carrying out deep dive audits. Yeah, I would completely agree with, echo the same sentiment that, I think companies increasingly are moving towards AI for, lending. And in fact, it's an important distinction for people to know that AI sort of automated lending, AI-enabled automated lending or ML-enabled automated lending is not the same as scorecard-based lending. Because in scorecard-based lending, you are already defining, what variables and what scores and, what variables are there and what weights each of those variables have. In AI-enabled lending, you're actually letting the system totally take the decision, and there may be supervised models or unsupervised models. But the point is, you are not in control anymore. So you're defining the framework for the system, but the system then sort of takes its own decision. So I think the auditing that will happen more on those frameworks. And I think what companies have done, and in fact, we are experimenting, we've not done any of this right now, what we're experimenting with is actually having a challenge the champion sort of run. So we are having AI models run simultaneously while, having our own scorecard-based models actually run on the ground. And I think when we start feeling comfortable, we are comfortable increase with this, but what we'll be doing is maybe opening up locations which are doing well, customer sets which are doing well on the portfolio quality, and segments which are doing well, maybe open up AI lending there and, see how it performs for a few months before we actually go whole hog and allow it for the entire industry, for the entire onboarding.
But even for AI lending, right, you're still, what drives your scorecard lending or AI lending is your past data. So that becomes critical even for AI lending, because you make decisions accordingly.
Yeah, no, I think that's absolutely right, Arun. It's just that, even on your past data, you have to be very clear about making sure the data is not getting dirty. So I'll give you an example. We've all mailed, most of the industry is running on scorecard-based lending in some way, shape, or form now. COVID has happened, and you will have a lot of great customers, performing very poorly. So your data feedback to your AI model will actually be quite dirty in that sense. And you have to figure out how you can, take off this short-term, spike that's going to happen. I'll give you another example. Now, when you've given moratorium to your customers who are not paying you are actually the worst customers, and the customers who are paying you are the better customers, even though they might be paying you slightly less than the EMI because they don't have the full cash flow. Because customers who've taken moratorium, there's a fear that they're actually worse off than the customers who are paying some amount, even though they're not paying the full EMI. But on your portfolio, those customers will actually be showing as customers who've gone delinquent. So I think it's very important to ensure that your that your model is actually learning from the right data set, and that you're categorizing it appropriately, you're defining the bad rates appropriately. Maybe we can hear Parijat's views also here.
Sure. No, I think I agree with you, Harsh. I think what is more important is to look at data in the right perspective, right? So data is oil, but if you don't really understand the data, the machine can actually give very, very different interpretations. And Harsh pointed out a couple of very relevant examples from the current situation of COVID, where maybe the interpretation of the same algorithm could be very different as compared to what it would have been, say, 4 months back. So what is important today is that people are not necessarily just dependent on a machine learning based algorithm. It needs to be evaluated, and I think I'll take an example of what happened in US with Apple Card, where there was a different kind of credit limits were being assigned to different members of the same family. So Mr. Steve Wozniak, who's the co-founder of Apple, his credit limit on Apple Card was 10 times of what his wife got, even though both of them actually shared every asset that they had in their household. Now there could be a counter argument that maybe the algorithm is biased towards gender, and that could really put a very, very large brand into a difficult situation. So a pure black box based machine learning algorithm is something that right now is not so prevalent in the financial, especially in the lending services business. So it is a combination of maybe the traditional scorecards, the rules that were being used, and also capabilities coming from machine learning. The advantages of each of these are manifold, right? A rule base is completely based on your heuristic, your understanding of the on-the-ground business models. Scorecards were built on maybe 10, 20, 30, or up to 100 variables, which were again coming from business understanding. As Harsh said, somebody will have to define those variables, and those variables then become part of your scorecard, though the weightages could be coming from a statistical analysis. But machine learning is actually picking everything based on data. Now, someone needs to make sense to machine, or someone needs to bring that business element to machine, or avoid these biases that may come up because of the data, the nature of the data itself. So that's where the combinations are really important. The advantage that machine learning is bringing to the table is it's not dependent on only tens or hundreds of variables. It can go to as high as maybe 10,000, 20,000 variables. And I think Harsh mentioned that people are using data from devices, people from data from SMSs coming in. Those data points are creating many thousands of variables, not hundreds of variables. And how do you really parse that? That's not humanly possible. And that's where you need capabilities of machine learning to bring in that assessment, but in conjunction with some human intelligence, which can make the right decision point for you. So I would go back to the phygital example that Harsh said. So over here also, it's more like a assisted machine learning or a assisted automation that you can bring into your credit decisioning.
Yeah, phygital is interesting, right? And what I'm hearing from both of you is nothing works in isolation on their own. So scorecards cannot work on their own. AI/ML cannot work on their own without support from scorecards and learning from it. Similarly, manual physical actions, people-oriented decisions will not work on their own. They're not scalable is what I'm hearing. A combination of these three different factors will play a role in how we are going to go forward in this aspect, right? So one of the questions...
Arun, just like one point here. So it's not necessary, it will not play out in any segment. And I think Harsh was trying to highlight that. There could be business segments that may emerge where this may be successful. So today, if you look at the payday loan industry, though it is very, very small in India, very large in some of the Western markets, but that industry is completely surviving on AI-based lending. They don't have humans sitting behind taking decisions. They are giving, say, 500 rupees to 2,000 rupees for just 7 to 14 days. If they have humans coming in, you can't really have margins to run that business. So there are pockets where this would work, but you will need to cover that with, say, a commensurate risk pricing. You will need to test few cycles. And so if it is like a 14-day loan, because you can test those cycles multiple times within 6 months, your algorithms also become smarter. But if you're looking at a 6 months or a 12-month window, then you need 2 years for your model to even mature and to make you, give you that comfort that this model will work for maybe a larger scale implementation of the same 6-month or 12-month loan tenure product.
I think that's where Murli's question, we have a question from Murli Srinivas, who asks, 5 years from now, will scorecard-based lending trump something like, will be trumped by something like AI and ML, or it will be the other way around? Harsh, do you want to share your thoughts there? I see you've answered.
Yeah, actually, I think my answer was similar to Parijat's. I said both will coexist, and AI/ML will be more widely used in small ticket, unsecured, high volume lending, which is exactly the example that Parijat gave today on the payday loans. Because it's just not viable for constant scorecard edits and constant human intervention in those kind of lending, being small ticket and being small margin. Whereas the scorecard based lending may be more prevalent in the high ticket secured. I think the main point here is that both AI and ML and scorecards are rooted in data, right? So both come out of data analytics. It's just that the prevalence of one or the other depends on the risk profiling, the comfort of the lending, and the risk ecosystem. Whether you're comfortable letting technology take decisions on large, on elements which would have a large say on risk. So what we've seen with algorithmic trading, causing massive volatility in the US markets, and then a lot of regulation came in. You can liken the AI/ML enabled lending to exactly that, right? So if you're taking large decisions, you want to make sure that you are not you're not having an issue of garbage in, garbage out with your data, with your algorithms. One could argue that even with small decisions, if there's a very large number of small decisions which are being taken, which are all incorrect, that can create a problem. But that's where you have your sort of spray and pray concept, that because I'm taking, sort of my risk is curtailed, I'm largely better off. So I think it'll sort of develop over time, but essentially both have their roots in data analytics. So I think as the industry develops and we become better and sharper at data analytics, we'll have these things play out.
Sure. We are running short of time, but we'll take one last question, which is on the credit decisioning for microfinance industry, and this is directed towards Parijat. So where Srinivasan Devanathan, he asks, how would you recommend digital credit decisioning in an MFI industry where customers do not have a smartphone, not in the digital banking habit as much as their customers in the urban areas?
So I think we should not confuse the data capture piece with decisioning piece. So data capture piece is a more customer interfacing element. Now in microfinance industry or any industry or any segment where you are serving the underserved or people from lower strata of the society, you may not necessarily have physical, like digital devices to interact. So you may not necessarily be able to capture maybe thousands of data points that you could do in, say, a mobile app-based lending business. But that does not necessarily mean that you cannot transform your middle platform. And as we mentioned, that your underwriting is the heart of lending. It's the brain of the lending, right? So if you actually put in automation there, if you bring in more standardization there, you can use other data sources. So for example, most of the microfinance players are using credit bureau data anyways for assessing the customer. There could be other elements which may come from, say, like from their bank statements or from their bank accounts, if they have Jandan accounts. If you can understand whether they are getting subsidies or are they getting any DBT payments or are they getting any payments under NRECA. So any of these data points, and I don't know what are the feasibilities of each of these data points, but you bringing them together, transform your decision process, take it away from humans to put it into system so that you can create a swim lane sort of a process, like a straight through process for 70% of the applications. As I think Harsh was giving an example, maybe 2/3 of their processes are going through that straight through processing. So if out of 100 applications that a microfinance processes in a day, can you put 70 of them through almost an auto approval mechanism, and 30 where still there is a need for humans to come in, humans to take a call in terms of whether the limit of the loan or whether it is in terms of pricing or whether to even take a basic decision of approval or a rejection. So whatever the case could be, I think the potential is there in every business of lending, whether you can do a 100% transformation, whether you can do a 70% transformation, whether you can do with 100 data points, whether you can do it with 20 data points. I think that parameter could change between the type of lenders, between the type of customer segment that you are servicing. But the possibility of digital transformation exists in every business, not just in financial services, but I think every business that we have in our economies. So, and that is holding true for lending as well.
That's very well put to, in fact, end the session. Maybe possibilities for digital transformation is there at different points in our life, not necessarily with respect to credit and lending institutions, but different businesses as well. So thanks so much. We've completely run out of time. Thanks so much to all our participants who joined today, and especially to Harsh and Parijat for taking time out. I'm sure you have other important things to do, but fully appreciate on behalf of all of us for taking time out and sharing your thoughts. This has been brilliant for me. So many learning opportunities, and I got to learn so much from both of you. Thanks so much for joining, and hopefully we'll see you in another session.
Absolute pleasure to be here, and thank you everyone for your time. Thank you, Harsh. It was a pleasure be on the same time with you.
Likewise, Parijat and Arun, thanks so much for having me, and it's been a good experience learning from Parijat and hearing you, Arun, as well speak. Yeah, thanks so much for having us.
Thanks so much, and we will see you in another session.